Most people over 60 think August is a quiet month financially. The big tax deadlines are behind you, the holidays are still months away, and if you're already receiving Social Security, your monthly check probably looks familiar. But there's a problem with that assumption. Some of the most important money decisions affecting seniors this year are being shaped right now, quietly, without a dramatic announcement landing in your mailbox. If you're 60, 65, 70, or older, 5 financial changes and deadlines deserve your attention this August. One could affect how much you can earn while collecting Social Security. Another could reduce your federal taxable income by thousands of dollars. Another could change how much you should be sending to the IRS. And one of the most important numbers affecting your Social Security check next year is being measured right now. None of this means you should panic. It means you should understand the rules before the rules become a surprise. Because in retirement, a small percentage or a few $1,000s can mean something very different than it does during your working years. Once you see the numbers clearly, you'll understand why this matters more than most people realize. The first thing to understand is that August itself isn't creating all 5 changes. Some are already in effect, some are approaching a deadline, and some are being determined right now for the months ahead. That's important because financial planning isn't just about knowing what changed. It's about knowing when a change becomes relevant to your household. And for millions of older Americans, the first issue is Social Security. If you're collecting Social Security retirement benefits and you're still working but haven't reached full retirement age, your wages can affect the benefits you receive this year. For 2026, the annual earnings test limit for someone under full retirement age for the entire year is $24,480. Social Security says that once earnings exceed that amount, $1 in benefits is withheld for every $2 above the limit. For someone reaching full retirement age in 2026, a higher limit of $65,160 applies to earnings before the month full retirement age is reached, with $1 withheld for every $3 above that limit. Once you reach full retirement age, the earnings limit disappears. Now translate that into real life. Imagine you're 63 and receiving $1,500 a month from Social Security. You decide to work part-time because you want the income, you enjoy working, or you simply don't want to stop. Yet, you earn $28,000 during the year. That is $3,520 above the $24,480 limit. Under the basic 1-for-2 rule, roughly $1,760 of Social Security benefits could be withheld. That's not a permanent tax on your retirement benefit. It is a withholding mechanism under the earnings test. And Social Security adjusts benefits at full retirement age to account for months in which benefits were withheld because of excess earnings. But here's where many people get caught. They don't discover the impact when they're planning their year. They discover it later, and that creates a cash flow problem. A household can look perfectly comfortable on paper and still have a difficult month when a Social Security payment is reduced or withheld. There is also a special first-year rule that can matter if you retire during the year. Social Security may evaluate earnings on a monthly basis under certain circumstances. For 2026, someone under full retirement age can generally be considered retired for a month if earnings are no more than $2,040 and the applicable self-employment conditions are satisfied. So if you're working and collecting Social Security, don't simply ask, how much am I making this year? Ask a better question, how much of that income is actually subject to the retirement earnings test? And when am I reaching full retirement age? That distinction can change the answer considerably. Now let's move to the second change, because this one is different. It doesn't necessarily reduce your Social Security check. It can reduce your taxable income. If you're 65 or older, there is a new enhanced federal deduction that applies for tax years 2025 through 2028. Eligible individuals can claim an additional deduction of up to $6,000. And a married couple where both spouses qualify could receive up to $12,000. The deduction is available whether you itemize or take the standard deduction, but it phases out when modified, adjusted, gross income exceeds $75,000 for single filers or $150,000 for all married couples filing jointly. Now, don't make the mistake of hearing $6,000 deduction and thinking the government is sending you a $6,000 check. That's not what a deduction does. A deduction reduces taxable income. The actual dollar value depends on your circumstances and tax bracket. For example, suppose an eligible senior has enough taxable income for the deduction to matter and receives the full $6,000 deduction. The benefit isn't automatically $6,000. If that deduction reduces income taxed at a 12% marginal federal rate, the federal tax reduction associated with that $6,000 deduction could be about $720 before considering the taxpayer's full situation. That's the difference between understanding a headline and understanding a tax rule. And there's another important detail. The deduction doesn't simply mean every person over 65 automatically gets the full amount. Eligibility, income, filing status, and the phase-out all matter. The IRS says the taxpayer must be 65 or older by the last day of the tax year, and the deduction is claimed through the applicable tax return process. So if you're 65 or older this year, August is a good time to ask a very simple question. Has my tax plan actually accounted for this deduction? If you're working with a tax professional, ask them. If you prepare your own return, look at the IRS guidance. And if your income is close to the phase-out range, don't assume the answer is all or nothing. The deduction phases out as income rises. This is where most people make a subtle mistake. They wait until tax season to think about taxes, but retirement taxes are a year-round cash flow issue. That brings us to the third money change, estimated taxes. If you're retired and most of your income comes from sources where federal tax isn't automatically withheld, you may be making estimated tax payments during the year. That could include someone receiving a pension, investment income, or retirement account distributions without enough withholding. The danger isn't only underpaying. Overpaying can also create a problem. Not a penalty problem, an opportunity costs problem. Suppose a household sends the IRS an extra $500 every quarter because its estimated tax payment was never updated after its circumstances changed. That's $2,000 over the course of a year that could otherwise have remained in the household's bank account. Maybe that money would have paid a utility bill. Maybe it would have covered a medical expense. Maybe it would simply have stayed in savings. The point isn't that owing taxes is bad or receiving a refund is bad. The point is that a refund can sometimes mean you gave the government more money during the year than was necessary, and this year's tax changes make that calculation worth revisiting. The IRS specifically noted that some new deductions can affect taxpayers' 2025 tax bills and refunds, and that people may need to consider whether their withholding or estimated payments reflect those changes. So if you're making quarterly payments, August is a reasonable time to review the numbers. Before the next estimated tax deadline, don't wait until you're staring at a tax return months later. Look at your actual income. Look at how much tax you've already paid. Look at your expected income for the rest of the year. Then ask whether your current payments still make sense. This is especially important for retirees because income can come from several different places: Social Security, a pension, a traditional IRA, a 401k, interest, dividends, capital gains, rental income, and these sources don't necessarily receive the same tax treatment. That brings us to the fourth issue, and this one is less about a new law and more about something happening right now. Your next Social Security cost of living adjustment is being calculated from inflation data. The Social Security COLA formula uses the Consumer Price Index for urban wage earners and clerical workers, commonly called CPIW. The formula compares the average CPIW for July, August, and September with the applicable previous third quarter average. That means August matters, not because someone in Washington is sitting in a room deciding what your raise should be. The number comes from a statutory formula. July matters, August matters, September matters. Then the data is used to determine the annual adjustment. The important psychological point here is that you shouldn't confuse a COLA with an increase in purchasing power. If your Social Security benefit rises by a few percent, but your housing, insurance, medical, food, and utility costs rise at similar or faster rates, your financial position may not improve much. Imagine someone receiving $2,000 a month. A 3% increase would be about $60 per month. That's meaningful, but if housing, insurance, prescriptions, groceries, and other recurring costs have increased by more than that, the household may not feel $60 richer. That's why retirees should think in terms of purchasing power rather than the headline percentage. And there's another reason to be careful. The COLA is only one part of the Social Security cash flow picture. Medicare premiums can also affect what ultimately reaches your bank account. Medicare's 2026 Part B premium and deductible were announced by CMS in November 2025, illustrating why the headline Social Security increase isn't necessarily the same thing as amount a retiree feels in their checking account. So when the next COLA number arrives, don't simply ask, what percentage did Social Security increase? Ask, after the other deductions and my household expenses, what actually changes for me? That is the number that matters. And now we come to the fifth issue. This one is not a single new law either. It's the growing importance of understanding exactly what income counts as earnings for Social Security purposes. This sounds technical. It isn't. It can make a major difference. Social Security's retirement earnings test is concerned with earnings from work. That is, fundamentally different from simply looking at every dollar that enters your bank account. For example, a retiree might receive money from a pension, investment account, or other sources that aren't treated the same way as wages under the retirement earnings test. That distinction is critical because two households could each have $30,000 of additional annual cash flow, but have completely different Social Security consequences depending on where that money comes from. This is where a lot of retirement planning goes wrong. People look at total cash coming in. The government may be looking at specific categories of income, and those aren't always the same thing. That's why the strategic household doesn't just track income. It tracks the source of income. It tracks whether that income is taxable. It tracks whether it affects Social Security. It tracks whether it affects Medicare premiums. And it tracks when the income arrives. That leads to a very important divide. There are two types of retirement households emerging. The first is the reactive household. Something changes. They receive a letter. They notice a smaller deposit. They discover a tax bill. Then they start investigating. The second is the strategic household. They don't know every rule. They don't need to, but they know which numbers to monitor. They know their Social Security benefit. They know their earned income. They know their tax withholding. They know their retirement account withdrawals. They know their recurring monthly expenses. And they review those numbers before something forces them to. The difference doesn't look dramatic in 1 month. But over 5 or 10 years, small financial leaks can compound. If you're 60 to 64 and still working, the priority is understanding the interaction between your wages and Social Security before your income crosses an earnings test threshold. If you're 65 or older, the enhanced senior deduction deserves a place in your tax planning. If you're making estimated payments, review them before the year gets away from you. If you're already retired, don't judge your financial health by the Social Security headline alone. Look at what actually arrives after deductions and what your household actually spends. And if you're helping an older parent manage money, don't just ask them whether they're okay, ask whether they've reviewed these numbers. Sometimes the most valuable financial assistance isn't giving someone money. It's helping them find the rule they didn't know existed. So what can you actually do this week? Start with your Social Security account and review your benefit estimate and earnings information. The Social Security Administration provides online benefit estimates based on your earnings record, which can help you understand how continued work could affect future benefits. Next, if you're under full retirement age and working, calculate your expected 2026 wages and compare them with the applicable Social Security earnings test limit. Then look at your federal tax situation. If you're 65 or older, determine whether the new senior deduction may apply to you and whether your income puts you into the phase-out range. After that, review your tax withholding or estimated payments. Don't try to predict your tax bill perfectly. Just make sure the assumptions you're using aren't based on a completely different year. Then calculate your real monthly retirement income, not gross income, not the number on a statement, the number that actually reaches your checking account. Finally, calculate your essential monthly expenses: housing, utilities, food, insurance, healthcare, debt payments. Those numbers tell you much more about retirement security than a headline about the economy ever will. And there's one final mindset shift I want you to remember. You don't need to predict the economy perfectly to build financial security. You don't need to know exactly where inflation will be 6 months from now. You don't need to predict the next stock market move. You don't even need to know exactly what next year's Social Security COLA will be today. You need to understand the rules that affect your household, monitor the numbers that matter, and leave yourself enough margin that a small change doesn't become a financial emergency. That's what retirement planning really is. It's not about getting every decision perfect. It's about reducing avoidable mistakes. It's about keeping more of your options open. It's about understanding that $500 means something different to a household with $20,000 in emergency savings than it does to a household with $500. It's about recognizing that a tax deduction is useful only if you understand how it actually affects your tax bill. It's about knowing that a Social Security increase is helpful, but purchasing power is what matters. And it's about understanding that financial security is usually built quietly. One reviewed statement, one corrected assumption, one avoided fee, one better tax decision, 1 year of consistent saving, and then another. If you're over 60, August doesn't need to be a month of financial anxiety. It can be a month of financial maintenance. Take an hour, look at your Social Security, look at your taxes, look at your income sources, look at your expenses, and ask yourself one question: if nothing dramatic happens, am I still moving in the right direction? Because that's the real goal. Not perfect timing, not perfect predictions, just the financial system that keeps working even when the headlines change. And I'd like to hear from you. Which of these 5 areas do you think retirees overlook the most? Social Security earnings, the new senior deduction, estimated taxes, the upcoming COLA, or simply tracking where retirement income comes from? Leave your answer in the comments. And if you want calm, practical explanations of the financial rules that can affect your retirement and household cash flow, subscribe. The goal isn't to make you worry about every change. It's to make sure that when something changes, you understand it before it changes you.